Okay, so we received a number of questions recently, which is really around the topic of whole life insurance. And really, an individual asked, hey, could you do a video on how people get ripped off on whole life insurance and how individuals think they're getting a good deal when they're actually getting ripped off? I don't really like the term ripped off personally, just because we see that out there a lot whenever we hear Dave Ramsey, hey, whole life's a rip off or something like that. But really, with a whole life insurance policy, how can we call it get ripped off or get put in a product where we find out after the fact, man, I could have set it up in a different way where it would have been oh so much better. So often, the number one thing we see here is an individual will purchase a whole life insurance policy for cash value accumulation. And they state, hey, my goal here is cash value. I like the idea possibly of having a death benefit long-term, but Steve, I'm interested in the cash, or agent, I'm interested in the cash value. So that's the purpose, the reason why they purchase. And then afterwards, they're sold a basic policy, which is really a policy designed with a high base premium, not attractive at all. Typically a policy with zero cash value in the early years. People aren't happy with it. Eventually they cash out. That's what most people are familiar with when it comes to whole life insurance. So that's what we see most often. However, there's different levels of it. So we're going to go through a couple things here. Let's take it one at a time. How people think they have not actually been ripped off. Right, so this comes up quite a bit when we start to design policies for maximum cash value, meaning I'm a consumer, I purchased a policy and I think I've got the best thing in the world, and then it starts to come to my attention, or maybe a friend brings it to my attention. Oh, wait a minute, this could have been designed stronger. Why was it not? Or expectations weren't set properly, or I thought I was getting this, and then it turns out I was not. Some examples of this. One is around the guaranteed rate and dividends. So with a whole life insurance policy, how it works is if I have a guaranteed floor of 4%, let's assume the company declares a surplus in earnings of 2%, the guarantee plus the surplus equates to the total dividend rate. Now the thing is, the guaranteed rate and dividend rate, whatever figure I'm using, is a gross rate that is credited after the cost of insurance, after the company's mortality charges. What is important to look at here, and every insurance agent will know what this means, is to request the net internal rate of return. That simply displays, when I pay money into the product, how much is the cash value growing net of all insurance expenses, fees, charges, all of that stuff. Because the thing is, and this often happens, people think they're getting a policy with a 6% dividend, and then long behold, hey, I didn't earn 6% on my money this year. Why not? Well, the dividend rate was 6%, but after the company's insurance expenses, the net internal rate of return was perhaps 4 to 4.5%, meaning that insurance expense will drag down the cash value performance. Remember, it is a life insurance policy. I am purchasing a death benefit here, and there is a cost there. Yes, we can minimize the cost, but that does exist. Important to be aware of that. That is one item. I wouldn't really consider that why one gets ripped off, but that could certainly create buyer's remorse where they were expecting a strong return on their cash value and then they didn't get it just because expectations or a proper explanation was not provided. Policy loans. So this we see quite a bit. The saying, pay yourself back the interest, right? Take out a loan and pay the interest back to yourself. This really revolves around a concept you may have heard of, bank on yourself, where we borrow from a life insurance policy and then we repay it with interest. So that concept really talks about paying a policy loan back and then paying extra money on top of the loan interest, which conceptually then how they will term it is you're paying yourself back interest. How loans work here specifically, let's pull up a quick visual. First, when I take a policy loan, interest goes to the company. Now, I'm paying interest on my own money. Yes, you can make that argument, but at the same time, I'm also earning interest on the money I borrowed out. Just like a piece of real estate, right? If I've got an appreciating piece of property, regardless if I own it free and clear, or if I have a loan outstanding, if the appraisal value goes up by 5%, the appraisal value goes up by 5% on the entire property. So how's the loan interest work? On the left, example, just paying money in, let it sit and grow. We're going to come back to this. Here's what I want to look at. We take a policy loan out, $200,000. The gauge that determines how much one can borrow from a life insurance policy is the cash value. You see that reduction there. The insurance company will also collateralize your death benefit. This way, if we die with a loan outstanding, the death benefit is paid out minus the loan balance. Remember, the insurance company's first and foremost obligation is to pay out life insurance claims. Now, what I want to specifically focus on in this example, which we've got videos on how loans work if you're interested in this, is here's my repayment. The loan interest in this example was 5% annual simple interest. But tally up those repayments. I borrowed out $200. I paid back $228,975. So I paid back my principal plus another $28,975. That interest did go to the insurance company. So again, if we stop there, that would not make any sense at all to do this. However, where it works out quite nicely for a policyholder is even though I pulled that $200,000 out, I continued to receive dividends and interest. This only reflects the surplus, not the guarantee, but I continue to receive dividends in the guaranteed rate on that $200,000 as if I never touched it in the first place. You can see that if we follow the dividend column while a loan is outstanding, and where you can really see it is let's look at when the loan is paid off. Cash value is 100% restored to exactly what it would have been as if I never touched it in the first place. Another way to put it is that there is no lost opportunity cost. What we're going to get into in our next point, has to do with this, which may have caught your eye if you've been exposed to a basic whole life insurance policy in the past with no cash value in the early years. Let's take a look here. So the break-even point. This is a great indicator to know if a policy is designed for maximum cash value or not. It is, when you look at the guaranteed values especially, and you can look at non-guarantees as well. So on this point where individuals think they have not been ripped off, but actually have, is what the individual wanted us to emphasize, is really the break-even point. So often we will see a policy not designed with a traditional 100% base premium, but typically breaking even around 7 years. What breaking even means is if I pay in $10,000 per year, 7 years into it, I've paid in $70,000 and I have $70,000 or greater. So 7 years to break even is quite some time. I remember I was at an event once and individuals were pitched on high cash value life insurance, and the individual, as we're going through the presentation, one individual made a comment. He said, hey, I was pitched on this before of putting $100,000 per year into a product, but it took 7 years to get my money back. Yeah, I'm not doing that. I'm not interested. Now, fortunately, we showed him how to completely do things different, where he would have his cash value up front and more long-term. But that's the kind of thing right there where we're showing a policy that looks good, 7 years to break even, and we hear terms like this, that you need to capitalize the policy first, or that less upfront will always equate to more money, or will potentially equate to more money long-term, where is that accurate? Will that actually happen? I'll tell you what, my background before I was in the business owner and sales side of things was designing policies for corporations. If you tried to throw this verbiage at them, right, a CEO or CFO in particular, you're not going to get the deal. Like, they're looking at it, they say, okay, we have policies on our books. We know how this works. We know what companies to vet. We want a policy that is optimized for cash value from start to finish. We want strong long-term cash values and death benefits, but we want it upfront as an asset on our balance sheet as well. So you can do it. For corporations, people are much more willing to do it because they're big dollar sizes. You'll see where I'm going with this. So again, we typically see a delayed break-even point. This is, again, where people feel that they're ripped off. And then we see an example where we can have 85 to 90% in the first year and breaking even between 3 and 5 years. Again, typically what we see here, right? So if you have a policy that's taking somewhere between 7 and 8 years to break even, you see a ton of emotion around that, but not many facts or data. Typically, oh, you don't want to look at a policy with an early break-even point because it will hinder the integrity of the life insurance policy. It's like, no. What does that even mean? When you look at corporations and banks and wealthy individuals, they value the money they put into their policies as everyone does. So we want to optimize that cash value as much as possible. Let's look at an example on this, because this is the number one thing we see very frequently. Here we go. So here is an example where one was presented a cash value life insurance policy. They thought they were getting a good deal, $100,000 per year going in, crossover point between years 7 and 8. Compared to a policy with identical out-of-pocket for the consumer, whole life insurance policy, non-MEC, they've got access to their money, all that good stuff. Look at the difference right off the bat. So we mentioned between 85 and 90%. Here we are at 87% immediately, as opposed to 73%. Okay, so the argument here often is, well, if you go with this option, you can potentially have much more long-term or you won't trigger a MEC. It's like, all right, just show me the numbers. If I'm a consumer, because a lot of this stuff is complex, make sure the policy is set up properly, or I've got maximum cash value from start to finish, and just show me the different options, right? If I'm an agent and there's a good reason to go with this option, I think it's in their best interest, or perhaps it is based off a particular company's flexibility features, make sure that you're showing both options. Because if I'm a consumer and I buy this and I never see this, that's where, if it was me, I would say, okay, like, why was this not shown to me? What's going on here? Break-even point between 4 and 5 in this example. Cash value difference is dramatic as time passes. It's more upfront, more long-term, but here's the thing. So when I talk about that emotional sale where people often don't even want to show this, here it is. Look at the compensation difference here. Huge difference, really at the consumer's expense. And again, this came from someone that wanted us to present this, how people get ripped off or think they're getting a good deal. And this is often what we see. Product with significantly less cash value from start to finish for a consumer, much higher compensation for the agent. Versus the right side, which is 3 times less compensation, but maximum cash value for the consumer. And you know, the way I look at all this is there's times where a higher base premium is absolutely appropriate. Again, it could be based off a specific company that we prefer. Their flexibility features require a higher base premium, and we look at that stuff. But at the same time, that's got to be disclosed to the individual, because going back to the point we just mentioned, if I buy the example with less cash from start to finish and find out someone made a huge commission where I could have been put in something else, or I would have went the other route, but I wasn't shown it, that's where the industry tends to get a bad rap, and we want to prevent that. It's not to say you can't sell those high base premium policies. There are times they make perfect sense because every company's different, but it's got to be disclosure, you know. So how people get ripped off, those are a couple ways. My big thing is see all the options, understand it in and out. This way I can make an educated, informed decision. Avoid this. That's usually a smoke screen to get someone not to look at the numbers. Because remember, it's your money at the end of the day. So as always, I hope this helps. Reach out with any questions and we will talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.